Welcome back to another episode of Fun Friday with a very special guest. We have Elijah Brown here, founder, CEO, principal, however you phrase it, of Goldhawk Capital. How are you today?
Yeah, that sounds great. Whatever you want.
Yeah, awesome. How are you today, my friend?
Great. Thanks so much for having me on. I know we've been in touch for a little while now, probably a couple of years at this point. So it's really a pleasure to have this discussion with you in front of all the listeners so they can pick apart and understand how we think about doing deals.
Yeah, and also critique us and flame us as one does, right? But with that said, it's no doubt that you are very seen on the streets of LinkedIn and really any social media site for, content and whatnot, which we'll get into, of course. But before that, let's just get an understanding of your background, who you are, where you're at right now, maybe if you want to dive into that, and kind of how you got to where you are today.
Sure, absolutely. So the real estate stuff really started in college. I was watching a ton of YouTube videos, and after watching a bunch of Brandon Turner videos and a few others, I was like, I'm going to be a real estate investor, need to start buying rental properties and scale a portfolio. But I didn't have cash and I didn't have credit, and I was doing the Army's ROTC program at the time so that I wouldn't have to graduate with debt. But I really didn't know how to get into these properties without having $50,000 for a down payment or a job so that I could qualify for a mortgage. And so I was raising money from the very first day. I called my best friend and my cousin, got them to jump in on a deal with me, and we went and closed our first single family property. So started off as an owner operator and did that for a while. Ended up doing four of the single family homes before I started getting into small multifamily, essentially flipping apartment buildings, really small ones, and then eventually partnering with other companies like you guys on some much larger deals, playing a specific role on the team, either raising money, asset management, underwriting, different types of things so that I could be part of the GP. And I did that for a little while. And then I decided that I was not really interested in being an operator any longer. And so I started just focusing on being on the investor side. I started a fund of funds where I raised money to invest in other people's deals. And now I'm doing a lot of equity brokerage as well. So arranging larger JV and co-GP checks for sponsors.
Amazing. And were those first couple deals that you did via the VA loan with your military background, perhaps?
No, because most people don't realize this. You don't qualify for the VA loan unless you have done a period of active duty service or you've been in the reserves or guard for 6 years straight. And so I knew what I wanted to do out of college because I had already acquired rental properties. I was like, I'm just going to go straight into the reserve and just start my real estate career. I had to wait 6 years before I could qualify for the VA loan. So I was using a conventional mortgage.
Right. Very cool. Well, I just had to ask because it is a very
Yeah,
nice
it
tool
is.
and certainly well deserved for those who can utilize it and take advantage of it. And they certainly do deserve it. So that's how you got into real estate. And then where we are today is certainly an interesting inflection point in time. So as we stand today, what is going on in your opinion? Because there's anywhere, any direction you'd like to see this, but there's clearly distress going on.
Yeah.
It's a very interesting chapter and season we're in. So, I'll let you take it away. I mean, what are you seeing? Because you're so well, I guess, read. You're kind of all over the place. So be curious to hear your insights. And is it pessimistic? Is it optimistic? Or is it somewhere in the middle?
I'm very fortunate in that I see a lot of deal flow. My presence on LinkedIn has allowed me to receive 50 to 100 deals in my inbox every single month from operators who are looking for capital, mostly equity. And so I like to think that I have, a finger on the market. I kind of understand what's going on, who's getting funded, who's not getting funded. And you're right, there's a lot of distress right now. A lot of operators are facing the possibility of giving keys back to the bank if they can't get a cash in refinance done. It's really difficult for operators to get under contract on deals because sellers are not yet capitulating. They don't feel like they're desperate enough to actually sell because, they wait until the last possible second when the bank comes knocking on their door before they'll give something away and lose all their LP equity. And so deals are starting to happen. They're happening though on more of the buyer's terms, in really distressed situations where we're going in and getting a 6 or a 7 cap on an A-class building in a primary market, and also assuming a 3% interest rate loan. And so those are the deals that are really getting investors excited and off the sidelines. And if you don't meet a whole number of very narrow criteria, the chance that your deal is going to get funded goes down a lot. We're seeing a lot of deals not getting funded, especially anything that's ground up construction. It's really, really hard to get equity for ground up construction projects. But for an experienced sponsor that knows what they're looking for and knows what the investor wants, there are deals to be had. There is equity that's really eager to get in, but it has to meet very specific criteria.
Have you found, I guess, on a normal market rate deal without some sort of unique wrinkle, like essentially, an exemption of taxes or an assumption play, or like heavily distressed, as you mentioned, that, a market rate deal, these big shops are just kind of not really saying yes? Because in my experiences, they're looking for the unicorn, but, the unicorn is, very few and far between, right?
It depends. It really depends on who's in the operator's Rolodex. A lot of investors invest with the operator because they trust them or they have a long-term relationship with them. And so I'd say like most of the battle is that relationship. But then when it comes to the deal, yes, investors are picking unicorns. They're waiting for that best opportunity. They're circling like sharks and cherry picking the needle in the haystack.
Without a doubt. So let's talk about markets. So due to the fact that you get, an abundance of deal flow, probably more than you can underwrite, I imagine you've got teams to help you do a little bit of gatekeeping on that. But with that said, markets. Have you seen there are certain markets that are doing better than others, or there's more distress? What's kind of your pulse on that?
Yes. So markets that have oversupplies, think like Phoenix and Austin. It's difficult because there was a lot of product delivered because of those low interest rates years ago. And so, occupancy took a hit there and properties are distressed and underwater and they're not even worth their loan amounts in some situations. Really great buying opportunity if you have a long-term approach. But it's still difficult to get transactions done. Then you have like growth markets. Like my favorite is I really like Dallas. You guys are in Houston and San Antonio. I like those markets too. Some of the other stuff in Florida we really like. But I just want to take a step back and go at a little higher level and think about what the institutional guys are really, really looking at. And by the way, they all have their own different markets that they like. But really, what we're seeing is the deal should be in a primary market or a secondary market that has at least 1 million people in population. Once you leave those markets, the demand for that product really falls off a cliff. And then you start getting into like the 7% cap rate territory of like, wow,
What's wrong with it? Yeah.
we're not gonna pay for that deal in like that's 2 hours away or 3 hours away from Dallas unless levered, we can pull 10% cash flow out of it every year. And so there has to be like a big trade-off there. We're even seeing in like the really hot growth cities like Dallas, where people were buying properties at like 3 and 4% cap rates, a year or two ago. We're now seeing those trade in the 5 to 6s. And so cap rates just across the board have really taken a hit. But if you're looking to raise money, I would stick with those primary and large secondary markets.
Right. And with that said, Dallas, you talk about that where, caps are expanding. Phoenix is no different than that. The
Yeah.
scary thing about, Dallas is that cap rates are changing like that, but insurance is substantially higher. and then your property taxes are likely higher too.
Yeah.
Of course, some of it's coming down in some instances,
Yeah.
but your expense ratios in a market like that, or Florida or Carolinas, anything with kind of a
Yeah.
coastal issue or insurance issue. I know Florida, obviously, with no income tax, they're going to get you one way or another. So
Yep.
it's very challenging to make those deals work. And I think a lot of distress we're seeing, even in the single family side of things, actually more than the multifamily, is seeing a lot of distress because things went
Yeah.
up very quickly, and now your expenses are, totally different, which is obviously eating away at the pocket.
Sure. I like that you brought up the whole property tax thing, which is something that you guys do really well. And just for those listening, when we decide to make a direct investment through our fund to funds product, one of our like criteria is that our sponsors have at least 5 full cycle deals completed. We make one exception to that rule, and that's for Lone Star Capital deals because they bring us some of the best deal flow that we've ever seen. And so when you have the best deal flow and a really solid team in place and have done a ton of transaction volume, we can bend the rules like that. But one thing that Lone Star is doing that I see a few others doing that we really, really like is they understand risk adjusted returns and outsized returns. What I mean by that is they're going in and they're looking for deals that they can implement a core plus strategy with a very minor business plan that has low execution risk and still achieve value add like returns because they're getting property tax exemptions. And those exemptions are pretty much guaranteed on day one, like when you go, because it's all set up ahead of time. So it's like you're buying the property and stepping into a 30% increase in your equity on the first day that you go into the deal. We really, really like those opportunities. We think those are great risk adjusted returns. So I wanted to say that because that is probably the best way to get investors excited right now. Have a low execution business plan with awesome returns. And you can do that by either getting a steal of a purchase price, getting a property tax exemption, or doing both, which is what you guys are doing.
Yeah, ideally it's both. And thank you for that vote of confidence there, because I
Yeah.
was definitely surprised when he said yes to us on the first opportunity we worked with together because our
Yeah.
exits were limited. I would make the argument that, more important than a lot of exits, okay, well, how's the portfolio doing? What's going on there? And, that tells a big story right now, because if you got really hot, you exited a lot of deals, but then made some mistakes of some floaters or some bridges that haven't been matured fully, we'll see how those go. And
Sure.
obviously, I think everyone's portfolio has that. We have some deals that we're still working through right now that might be challenging, but that's just kind of part of the market. We've never made a capital call. We hope to not, but you're not a bad person or a bad operator if that happens. It's just don't do it again and make the same mistake again in the next part of the cycle. But with that said, sponsors. So you get a lot of deal flow.
Yeah.
What's the quality of sponsor like? Because I have to imagine, since you're very public, people see your stuff, they engage, they email with you. How many of these deals are being totally, just deleted right away? How many of these deals look just absolutely ridiculous? Like, I'm very curious to hear your perspective on that matter.
Yeah, roughly half get thrown in the trash immediately.
Right.
It's either because it's just, it's a ground up development deal we know we can't help, or it's, someone's first deal, or it's just a crazy deal, or the marketing materials are unprofessional. So that's another thing that we see a lot of. In terms of what we're looking at, so you got to understand that if you're an operator who's got 100 or 200 deals full cycle and have been building relationships with family offices and institutions for sometimes 20 to 40 years, um, you're not searching for equity providers on LinkedIn. Probably not. You're probably not hiring equity brokers. You've probably got a very close knit circle of investors that you're going to on a one-off basis to ask for, $20 million checks or whatever you want, or your stable of investors that you're sending an email to. And so what's left? It's really emerging sponsors and the experienced sponsors who haven't yet tapped into those really close, institutional, programmatic types of JV partnerships. And by that, I mean, an institution will come in and do 90 to 95% JV on every single deal that you do. and you no longer need to go retail with the equity raising. And so we're seeing a lot of sponsors that have, between 1 and 50 full cycle deals. And so we call anyone with like less than 10 emerging. And then we typically are looking for, 5+, which does eliminate quite a few people from what we're looking at. But we like to see the deals because we will follow a deal. This is what we did with Lone Star. We'll follow their deals for 1 to 2 years before we engage to write a check. And so if you've got a deal and you only have 1 or 2 full cycle deals, keep sending it to us because we're watching, and this is building trust for when we're ready to pull out the checkbook. And then you might get lucky and be in a situation like Craig and Rob, where they have one of the best deals I've ever seen. And then I'm compelled to invest because it's a situation where it's a solid deal and it's difficult to screw it up because it's a simple business plan. So
Yeah, and
yeah,
it's funny. What kind of really overcomes, to your point, what we're getting at here is if the basis and business plan are straightforward and good enough, like really good, you can get away with a lot. But of course, a really great sponsor, which is why you want to work with people who've got 10 plus exits or so, typically speaking. The miss rate is substantially lower, someone like that. But if the deal and basis is so good, and so how could you not? Those are the rare exceptions and whatnot.
yeah,
So that's definitely a key distinction to make there. And about the emergent thing, you're absolutely right. I was talking to some shops as well who define us not as emerging anymore, but we're kind of in that cuspy where we've got over $500 million of AUM, only a
sure,
couple exits, but we've been in business for almost a decade, better
yeah,
part of a decade. So we're not quite there yet, but we're really close enough where we are interesting and compelling. And so, we've seen that before. We are right there. And business only gets easier the longer you're in it. And to your point there about sending deals, a no is not a no indefinitely. A no is a no for right now. And we've even
yeah,
sent deals before where I followed up with them and said, hey, this change or this, that. And they kind of flippantly said no. And then they actually looked back into the deal again and realized, oh, actually, I like
yeah,
that. I want to partner with that before. So for any sponsor out there, a no in the first way around, maybe not actually, or may not actually be a no during the entirety of it. So I'm sure you've seen situations where people have kind of sent it to you. Maybe their business plan had X, but then Y changed, which made you
hmm,
feel comfortable and got you over the hump.
sure, yeah,
Yeah.
absolutely. Maybe they're coming to us. They haven't figured out the debt yet, or a large portion of their capital stack, but then they come to us and they're like, we got the most incredible interest rate. We found investors. We've got, this amount left and we're ready to go. We're ready to close. And by the way, the property's now at 90% occupancy. I'll be like, whoa, okay, maybe we'll
Yeah.
reconsider the deal. Yeah.
Right, for sure. So you said, marketing materials and whatnot. And then,
Yeah.
I always think about quality of people. So when you do meet with a new group, when you do connect, what are some of the things you're looking for, like a sniff test, if you will, to make sure that they
Mm.
seem credible and viable? Do you do background checks? How are you meeting these people typically as well?
Yeah, it's a good question. For me, it's more about the numbers in the beginning. So I want to know about their assets under management. I want to know their full cycle deals, how those return rates compared with the projections, and if they didn't meet the projections, why. I want to know if they've ever lost money, if they've done capital calls. I want to know the timing of their communications, their distributions. But then also, I'm just like doing a high level gut check on their like moral and ethical character. It's like, I don't want to be doing business with someone who's an asshole because chances are that spills over into how they're managing the property too. And so we'll usually jump on Zoom like 1 or 2 times, and then as we get closer we might have another couple of check-ins. But I mean, with Lone Star, it was a situation where like I had already met Rob 2 or 3 times and had jumped on Zoom with you guys like 2 or 3 times after that before we wrote a check. And so we really, established that relationship over a few years. And not only that, I think like the majority of what got us onto the table in terms of trust was all of the nurturing that you guys do with your content. So you and Rob are constantly putting out videos talking about the properties and the performance, doing the quarterly webinars, sending out a newsletter every month, really staying on top of it, going to the conferences, setting up booths, jumping on stage and talking about the market. It's like you can really see that as an investor and be like, these guys know what they're doing. You know, they're in the room and have their pulse on the market. It's like it really, really helps with the trust there. So
Yeah, and I recall we actually met at BEC
yeah, I think
last year, if I'm not mistaken.
yeah,
So, you know,
2023. Yeah.
it is really good to meet those. And that's like conferences. It's not about anything content related for kind
Yeah.
of Rob and I, and I'm sure yourself. It's we're like, hey, I'm actually doing some deep level, high level due diligence here, whether you're meeting with Rise 48, with
Yeah.
Lone Star Capital, XYZ, Viking Capital, sponsors are there. They'll make themselves available. It's kind of a who's who, and you know, kind of one of those annual meetups. On that note too, are you planning on going to many conferences moving forward with kind of your new position? You know, how do you view
Yeah.
sponsors as a capital allocator? I'm always curious to hear that.
It's hard now that I live in Hawaii. It's like I have to fly
Yeah.
around the world just to do anything. And so,
Yeah.
I'm going to conferences here. I actually spoke at a conference last weekend. But like I'm attending conferences here, and I will selectively go to 2 or 3 conferences on the mainland each year. But I'm really trying to just go to a conference when I am invited to speak on stage, because then my time there is way more worthwhile. The reason why is because when you go and speak on stage, everybody in the room assigns a certain level of trust to you. And when you go to talk to them in person, there's already a baseline level of trust before you start talking to them. Whereas if you're just showing up at a conference and you don't know someone, then you have to spend the first 5-10 minutes establishing that trust. And so the short answer is yes. I will be going to a few select conferences, probably more of the like family office type conferences, just because my function is now to connect family offices and institutions with operators. I'm not really going as an operator anymore.
Right, that makes sense. And then as you mentioned there, you know, you want to connect group A to B, segueing to kind of other items, other properties. Have you only been in multifamily, or have you been in any other asset classes? Are you in any other asset class right now? Or are you pretty agnostic?
Yeah, I made the conscious decision a decade ago to get super, super niche on multifamily. I went into it with the thesis of everyone needs a roof over their head. It's like hierarchy of needs. Everybody's gonna need like a market rate or affordable type of shelter. And so I've only been in multifamily the entire time, and not even any type of multifamily. I've been in like workforce housing multifamily the entire time. It was only this past year that I got out of Arizona and Texas. It's like I was
Right.
trying to stay like super niche and become an expert in one particular market. Same thing with you guys, being in Houston and then going to San Antonio. I started off in Phoenix and then went to Dallas and then San Antonio with you guys, and now in Jacksonville with ATX acquisitions and a few other things that I've got going on. But I'm trying to diversify and expand out really slowly because I want to be that niche expert in whatever I'm doing.
Right. So with that said, let's talk about states, locations. You
Yeah.
started in Texas and Arizona. What was kind of the thought there? And then now that you expand, you know, kind of, I would be curious to know kind of your
Yeah.
your thesis there as well.
Yeah, I'll just keep it as simple as possible. Folks were moving there. It's very business and landlord friendly. And that's really it. It was like, let's look where all the people are moving, where all the business is going to, where we can grow our money. And it just happens that like the Sunbelt red states happen to be the best area for growth. You know, so we ended up investing a lot there, and we're still investing there and expanding out within those Sunbelt red states. So we've got, Texas, Arizona. We're now in Florida. We're looking at the Carolinas, and Georgia. So, we're pretty bullish still on the Sunbelt.
Does it ever feel like a learning curve getting to a new state? Because, you know, cost per door in Dallas or Houston as opposed to Arizona is wildly different. Well, why is it different? It's not that the rents are all too different, but it's because your expenses on a property are substantially less. Being an Arizona resident, I can tell you that our insurances and our property tax is legitimately next to nothing. That is not the case by any means in Florida or Texas. So is
Yeah.
it kind of weird seeing, I guess going from, I guess maybe those two states to a new state to kind of learn the new language and kind of the new, I guess,
Yeah, kind of. Here's the
pricing,
thing,
if
from
you
my
will?
perspective, it's like we're really getting in bed with an operator, not the deal. So it's like we're trusting you as the local market expert to understand all those risks to like a very, very, detailed level and be able to mitigate them and report on them to us. And so for us, it's like we're looking at it from the perspective of like, what's your DSCR? What's your stabilized yield on cost? What's the net IRR that I'm getting, out of the deal? I don't care about your insurance line item. That's your job to worry about. Like I chose you and invested with you because I've been watching you for 2 years and I trust that you're going to do your job. Now, obviously, we go through a due diligence process. We have like a big spreadsheet that my analyst goes through and fills it all out. But I mean, 80% of the thing is just getting the relationship with the sponsor. It's funny talking about these differences and like things like insurance and taxes and stuff because like I'm out here in Hawaii, which is
The worst of the
like
worst, probably.
90%
Yeah.
higher than the average living cost. It's
Yeah.
crazy. And so like we have like $1,000 a month HOA fees. And so
Right.
it's like when I hear about like a house costing like $500,000 or like your insurance, going up from like, I don't know, 250 a unit to like 400 a unit, I'm like, come on.
Yeah. Yeah.
It all
But it's
gets,
not
it all
nominal.
gets,
Yeah.
yeah,
Not nominal
it's
spread
true.
across 100 plus units. But to your
That's
point,
true.
it's
But
different.
it is reflected in the NOI. Like it all boils
Correct.
down to like an NOI at a cap rate. And so regardless of what those expenses are, it's, it doesn't impact the market cap rate, right? Like,
Yeah. So how do you compare apples to apples then when it's really not always apples to apples? Let me explain. Like
yeah.
a core deal in Dallas is if that's whatever cap compared to a deal in Los Angeles, totally different, right? So that said, when you're looking across the marketplace, what are some of the metrics that allow you to feel comfortable with one deal being better than another? I mean, obviously there's some factors like, going in cap rate, your
Yeah.
debt, things like that. But how do you really quantify, numbers if you're looking at a Florida deal, a Texas deal, or, an Arizona deal? Like, how do you kind of
Yeah.
navigate that process? Because it can't be easy. It's not
No, it's
uniform in many
not.
respects. It's art and science, right?
It is, and it's interesting, like thinking about it from like the sophisticated investor's point of view versus the operator. So in your world, you're so hyper niche in your specific local market, that you're really like worried about like apples versus oranges in different markets. Whereas from the investor's point of view at the higher level, we're going all around the country and speaking to all kinds of different operators, and so we kind of need like some type of like thought process that can help us like standardize everything that we're looking at so that we can compare them. And so it really boils down to us. It's like vintage, primary, secondary market, asset class, and then from there like cap rate. And it's not like we're looking at every market from like, oh well, what's the insurance price per unit in this one versus this one, because it's insignificant when you compare it to some of the much larger metrics that we look at. And I'll just go down kind of the list of like what we're really looking at. First and foremost, is the going in cap rate. So a lot of people right now are overpaying for properties because they're assuming a loan at a low interest rate. And they think, wow, that's going to create fantastic cash flow. It's got what we call positive leverage. And it's like a really strong deal because we're buying at a 4% cap rate and we're getting a 3% interest rate. Well, it doesn't work like that. And it's not a good enough excuse because eventually that loan expires. That loan maybe has 5 years or 3 years, whatever. It's got 7 years. And then you're stuck with a property that your total all in cost to buy that property, to close on it with the transaction, to renovate it, ends up actually being more than what the property's really worth in cap rate in 5 years from now. And so, like, you can't buy a property at a 4% cap rate when in 5 years from now, you're projecting a 5.5%, cap rate. Doesn't make sense to like go overpay like that. So that's the first one. The second thing we look for is the positive leverage. So we want to make sure, and it really boils down to this, people keep complicating it, but as I get more and more years ahead here, it really boils down to the same, like very simple, basic crap that like we probably learned on day one of real estate 101, which is like, I want to make sure that the cash flow that's coming in is enough to actually pay the mortgage every month. And then like maybe have a little bit left over to put in my pocket. That's as simple as I can make it.
Revolutionary concept, I know. Yeah.
That's what positive leverage is. And if essentially the formula is take your going in cap rate minus your interest rate, and if it's a positive number, then great. It's okay to like borrow a bunch of money because you're going to be able to make those payments. But if that number is negative, as in you're going into this with a lower cap rate than your loan interest rate, maybe borrow less money so that you're not broke after you pay the bank. And so that's like really what we look at. We like to see DSCRs in year one over 1.25. So we want the net operating income to be 125% of whatever that debt payment is.
Yeah,
And
in
that's
the
just
most simple terms, everyone, for who doesn't know what this means, for every dollar of debt, you want $1.25 coming in. Okay, so this is the most
awesome.
simplistic way to explain it. Yeah.
That's great. And by the way, that's bare bones. Like you're telling me that like at the end of the day, you're just gonna like have like 25 cents left. Are you kidding me?
No.
So like a good DSCR would be closer to like 2.0. So
Right. Right.
that's why it's like when we're looking at like once you've accomplished your business plan, you renovated the units, you got your property tax exemption, whatever, like has that really stabilized? Is it safer now? Are we closer to that 2.0 debt service coverage ratio in that situation? And then the next thing that we look at is our stabilized yield. So this is like our year three net operating income divided by our total all-in cost, which includes the purchase price, the renovations, the transaction costs. We want to see that to be healthy enough that the investors can make a solid, maybe like a 7% annual dividend on their money every year. And typically, we need to see like a 7 to 8% yield on cost there in year three for when it's stabilized. Other than that, it's really that simple. I don't have a crystal ball. I personally don't really care what your exit cap rate is unless the IRR and the equity multiple is so thin that like it really matters where your exit cap rate's at. In the case of the deals you're doing, your projections are so high that it's like even if I went more conservative on your sale price at the end, like I can get way more conservative and it still meets my criteria for return rates. It's like I need to get a 15% IRR on my money. Well, Craig's over here offering a 22% IRR, which means that in the case that Craig screws up and sells that property for way less than he thought, we'll still end up getting our returns. And so I'll get off my high horse now, but
Yeah.
exit cap rate important, not as important because we don't have a crystal ball here. Just need to
Well,
make sure there's room in there.
exit cap rate's very contentious too because it really can fudge or change around your numbers. So to your point, I actually like that. Keep it simple. If you believe in the deal, if the going in metrics are good enough, if you're buying it well, below replacement cost, right, then you're probably going to do fine. The margin and how well you do is remaining to be determined. That's why, when we go through deals, I think one of the biggest things you always ask for is what's breaking even occupancy. Are you concerned? Your sensitivities, you like to ask that, which is very smart. So that said, though, you mentioned something I want to get into this leverage. In this day and age, it's harder to get because, cap rates are, haven't moved that much, probably as much as, buyers would like. So it's still very tight. But leverage obviously can really juice up a deal. So how do you look at, that? Do you have a certain thing that you're looking for there? Because obviously we could lever up a deal substantially to about, on some deal we're doing right now, we're about to launch to 65% LTC or, as opposed to 75%. Well, if we put it 65%, now the cash on cash looks wildly different, but the IRR is lower. So do you have any kind of opinion on that
Are you
matter there?
asking about like loan to cost leverage or like spread leverage?
I'm saying like, because if you lever it more, if you put in 10% more on that, you're going to have more cash on cash, but your overall IRR is going to get
Yeah.
shrunk, right? So do you have a
Yeah.
certain kind of opinion
Really
on that?
depends on the yield. So
Yeah.
we're looking at deals, and there's like two different types of deals we're really looking at. If you do like a heavy value add project, um, you're going into it and you might have you might have negative leverage from a spread perspective, but then you're stabilizing at a really high yield, and so it's not really as big of a deal. um, but I would say like that means the situation is a little riskier when you're going in a situation where your yield is low, compared, or your net yield is low after you pay the mortgage. Probably should borrow a little bit less money, use more cash to do the deal because it's riskier. Yes, of course, it sucks to not be able to like borrow as much money as you want and juice those IRRs on those that cash that's invested, but you're taking a lot more risk by doing that. I would say like if the going in yield is really solid, like really high, you're positively leveraged by like between 1 and 300 basis points or more. It's like go lever yourself to the moon with debt. Go borrow 70, 80%. Like, I don't care. That's great because you're going to be able to make that payment comfortably. But if you're going into it with a low amount of yield, then I think take less debt.
Without a doubt. No, that makes sense. And it's, I think we see the world similarly there. It's got to make sense. We don't want to, have paper thin margins, but similarly, it doesn't make sense to raise too much money just to have a cushion and to do special distribution halfway through because we can and
Right.
we're stable, right? So it's always the yin and the yang there for sure. And then obviously a lot of people, and if you do bridge deals and whatnot, overraise because they're paying back on the Joe reserve, which is basically paying back investors' dollars on the front end for those
Yeah.
monthly distributions too, of course. So there's a lot of tricks and games people can play
Yeah.
naturally through the process. And with that said, it seems like metrics are, I thought it'd be more straightforward, but the deeper I've gotten into this, a cap rate for us is different than a cap rate down the street, right? So no, everyone
Sure.
underwrites slightly differently. So have you seen moments where you've had to kind of really ask in depth? And I'm sure once you have to do that, the answer is probably no to the deal. But do you often see people miscalculating certain metrics in the
Oh, there's
underwriting?
so many different types of cap rates and metrics. So sponsors who don't understand how to market their deals correctly or effectively will use the straightforward T12 cap rate just from straight historical 12 months. Then you get a little more sophisticated and you've got people taking the T6 or the T3 and annualizing it because it's a better like reflection of the current situation.
And
Great.
surely no one's fluffed up a deal before putting the deal on the market,
Really
right?
not.
Or during contract. That's never happened to any of us in this conversation.
Right. But
Yeah.
then you get to the sophisticated sponsors, who do it a little bit differently because they say, well, the expenses that happened in the past are not normal. They're not reflective of what's actually going to happen in our first year here. And so it really doesn't make sense to even look at those. We need to adjust that stuff. Like, for example, we're putting a property tax exemption into place on the first day here. And so our property taxes are going to be half of what they were last year. So it doesn't make sense to base our going in yield, our going in cap rate off those expenses. And so they'll adjust the expenses to be a more normalized situation. And they'll use the T3 annualized revenues on top of that. And that produces a higher cap rate. But my personal opinion on this, even though it's a less conservative cap rate, it is a cap rate that more reflects the actual situation that's happening, the actual going in yield. It is more real, I think, than using just the straight T12. And so that could be the difference between, investors wanting to invest or not. And so I'd say, position yourself the best, be very transparent about what you're using. We're using a T3 annualized tax adjusted, expense adjusted cap rate here. And if you want to calculate the rest of them, do it yourself. But I think that is the best way to do it. And it really highlights the true and correct situation of what's happening.
Yeah, what we look to do at Lone Star, just behind the curtain, is we take the T12, as Elijah has alluded to, and then with our in-house, vertically integrated property management company, construction management company, we basically line up what we simulate expenses to be with the income before to give you what our going in day one cap rate would look like. And then, of
Yeah.
course, we have a stabilization period, and we get to the yield on cost, which is arguably, as you alluded to before, probably the most important metric to a lot of
Yeah.
people is that. So something that I thought about too in positive leverage has been something that you've been harping on, and most smart people in the industry are, which makes sense. If you, as Barry Sternlicht said, positive leverage, who by the way is, if you don't know who he is, you should know who he is. Look him up. Pause this podcast, go look him up, then come back to here. But if you buy on positive leverage and below replacement costs, you don't lose money in
Mhm.
multifamily real estate, right? Um, it's challenging in some markets to hit positive leverage, though. And the
Yeah.
market I have in mind would be something like Dallas, Texas, where we're just really not seeing, cap rates with how
Yeah.
we scrutinize deals really get over a 6, which would have to basically hit your positive leverage unless you really chimed treasuries very well that day and rate locked on an optimistic, I guess, day or time of the cycle,
You need an
right? So with that
assumable
said,
loan in that situation. Yeah.
yeah, so it's brutal because we, like everyone else, want to buy in Dallas, but it's very expensive.
Sure.
Do you ever make exceptions in situations like that, or are you pretty steadfast with
Yeah.
today right now that you need it to be X because it doesn't make sense until I guess things are a little
Yeah.
more smooth?
There's like a very clear way to easily add value and get that yield up, without a ton of execution risk. Sure. Yeah. Yeah. It's like sometimes it's worth just like paying what you need to get in because it's a very clear pathway to a really strong yield and a really high quality property, that's worth a lot more money than your total cost going in. So yeah, there definitely. It's just it's difficult when investors are waiting for that one deal in Dallas that one sponsor is going to bring them that has all the things. Um, the problem with going into these negative leveraged deals is that you're not going to hit a very high year one cash flow net to the investors. And that's something that a lot of people look for. They're like, I don't want to wait 2 or 3 years to start making passive income on my deal. Like, I want it now. I want my 5% yield now. And I want the deal to be like safe. And I'm like terrified and have PTSD because of all these properties I lost money on the past few years. Like, I just want to invest in the safest possible thing and make some passive income. So it's tough. It's harder, certainly harder to raise money for those, but it's possible.
What we want to graduate to is a point where we can get investors psyched up and hyped up on a 12 IRR and like core
Oh, I
Dallas or
know.
Houston or
It was
Austin, where
five
it's
years
like,
ago.
yeah, well, no, but like, hey, a
Yeah.
12 IRR, nothing sexy, the best location where, hey, this is not, we're not the operator
Yeah.
who's going to pitch you a 20 or 25, something egregious like that. We're just trying to give you the best looking returns or the best deal possible that you invest
Yeah.
in and your capital is safe. So eventually we want to graduate to being those operators. But for the meantime,
Yeah. That
it's
takes 100 full
opportunistic.
cycle deals.
Exactly. Yeah. Or you're raising all internal capital, friends and
Yeah.
family only, and it's
Sure.
in-house and you're not using other people's money, of course. So,
Yeah.
that's the ultimate ascent, if you will, is to get there. There's a group called
Sure.
MG Capital who is kind of our North Star, if you've heard of them. They're
Yeah.
as elite gets, and they're buying deals in Fremont, California. They're buying deals in
Yeah.
Denver, Colorado. They're buying their portfolios all over the place, and they're doing some really awesome things. And they've been very good along the way and in the process, and have had truly outsized returns, and only invest money from retail investors, which is basically in-house investors, and then they just 1031 exchange from deal to deal to deal. And by doing that,
Awesome.
they've created a lot of shareholder value without a doubt. With that said, what do you think will do the worst coming up asset class wise? Obviously office is scrutinized. You can view that, but you could take a different angle there. But what's giving you, I guess, from a market perspective, giving you nervous? It doesn't have to just be real estate. You could say a cryptocurrency is going to go down.
No,
Whatever
I'm
you
going to
want.
stick with real estate. It's the vintage problem. Investors right now are like really like scared of older vintage. So we're seeing like demand for 70s product has fallen off a cliff. Demand for 80s product has fallen off a cliff. People want to see 90s and newer. They like the newer the better. And that's because we can buy right now for less than replacement cost. Like cap rates have no doubt expanded quite a bit, and we can now buy those nicer properties. at a discount. And so people are like, I'm not going to risk it with like buying a 70s or a 60s or an early 80s product when I might get stuck holding it or having to offload it in 5 or 10 years at like a fire sale price. And so, people are getting smarter about that. Also, the problem you're seeing is like you still can't buy a 70s product with enough cash flow to make it worth it. It's like there's a reason, why those products trade at higher cap rates in, secondary and tertiary markets and older vintage. But the problem is the sellers are still not giving up on those. And so that's we might see more of that coming up in the future. But like personally, for me to get invested in a 70s product in a secondary market at this point, I'm going to need a year one 10% yield net to me on my money. It's like it just doesn't. It hasn't happened yet.
Yeah, and also to your point there, pricing has stayed pretty strong, but wide enough on newer stuff. But pricing is getting, we still don't know where the bottom might land on the kind of C older stuff. But of course, 70s assets are different. Like you might buy 70s assets product in the Bay Area or, someplace in a state where
Sure.
development's not easy, or the Northeast like Axel does, where it's kind of built differently, right? It's not the same conversation. But 70s in Texas, there better be a good
Sure.
story behind it. We're buying a deal right now in the 70s. We think it's a very clear path. But with
Yep.
that said, that's a very unique situation. And we may not buy another 70s deal,
Yeah.
in the rest of Lone Star's history unless
But
someone's
you
giving it away on
somehow you were
charity.
able to get a steal of a price on it, and that's really hard to do. I would imagine you were tracking that deal for 6 months to a year before you got the contract.
We didn't even buy it at the highest
Okay,
price. We just got it out of, reputation with the brokerage and
there you
whatnot.
go.
So, and that's, unique place, of course, with working with top sponsors, which obviously, all too
Yeah,
well that if you work better, you don't have to pay the highest price, which,
sure.
of course, price and location determine, how well your investment will do. With that said, what is on the flip side, what do you think will do best?
Hmm. I think right now the newer stuff in primary markets, the stuff we all want. It's like,
Yeah,
we're it's not going to have as much capex concern. We don't have to worry about operators, screwing up the business plan, which has happened so much over the years of like not completing renovations or stuff like that. Um, so I'm really excited about A-class stuff in primary markets that have property tax exemptions. I think the largest demand in this country is for affordable housing. So to the extent we can get into like newer product for affordable housing, I think the demand will fuel NOI growth in that sector for a long time.
without a doubt. What products do you have? I know obviously you've got a lot of stuff on LinkedIn. You've got, a ton of resources, free information out there. You're really an educator in that regard. So give
Yeah,
yourself a shameless plug here. Where can
sure.
people find you? We got one question after this, but where can people find you? What products do you have? What would you want people to kind of look up?
Yeah.
And, how can you be helpful to others in the network?
Well, first of all, I'm on LinkedIn, so search my name, Elijah Brown. I'll pop up. But on my website, goldhawk.us, we've got a ton of free resources that you guys can download from the media tab. I've got stuff for both LPs, operators, anyone really interested in multifamily or want to know what I look for. To understand really like on a deeper level what I look for in these deals, you can go to goldhawk.us/ebook. If you're an LP investor and you want to get a little more granular with calculating metrics, you can go to goldhawk.us/LP calculator. So those are just a few.
Perfect. Final question. What is your hottest real estate take?
Oh man, there's a really awesome opportunity right now to achieve opportunistic and value add returns on core plus strategies. And I've been talking about this the whole time, really. You can buy nicer buildings with a lower lift with experienced teams and get the returns that you would have expected 2 years ago from like a really heavy renovation project. So they're out there. It's few and far between. It's like searching for a needle in a haystack. But I'm seeing them through my deal flow. Others are seeing them. Lone Star is seeing them. So look for those opportunities. You shouldn't be going into a really heavy value add deal and only getting a 15% IRR right now.
Yeah. And as you mentioned before, risk adjusted is the name of the
Yeah,
game. That's a key word, folks.
outsized.
Exactly. Well, it's like, hey, a 15 IRR on a 2020 property and a 15 IRR on a 1960s property in Texas
Different.
are different conversations, as we know.
Yeah.
Well, Elijah, thank you so much for coming on the show. I have no doubts you'll be coming back again in the not too distant future. For everyone who's listening, thank you so much for your time, and we'll see you next week.
Thanks, Greg.